here's the basic thing. I just don't think trying to fight inflation that we're seeing with 2% interest rates is enough.
Good afternoon, everybody. Today I'm interviewing Jim McFadden, contributor over at The Deep Dive. In this interview, Jim breaks down the case for interest rates to be way north of here. Jim breaks down the analysis of the electric vehicle sector. And if you watch until the very end, you can see Jim McFadden, the chartered financial analyst himself, break down two stocks he really likes on the long side at this particular point in time. All right, everybody, enjoy the interview. Jim, thanks so much for joining us.
Well, thank you very much for having me. It's a real pleasure to be on with you folks.
So Jim, let's talk about when COVID started, the quantitative easing and fiscal packages that we saw, and ultimately kind of what that took us through. We obviously saw quite the speculative bubble with names like Cathie Wood and Ross Gerber coming to the limelight in all these pre-revenue cash burning tech deals. Many of those names are now down over 80% plus. Where do you think we're going from here?
I mean, that's the question which is on the tip of all investors' tongues. And as you kind of mentioned at the top, you know, the S&P is down about 20% year to date. The NASDAQ maybe 27, 28. And the hope is that might represent a reasonable bottom or base. The fear I have is I think the market is fairly vastly underestimating the effects of what the Fed and other central banks are doing. I mean, one of the first lessons as an investor is don't fight the Fed, and keep in mind here the Fed funds rate is 1.75% now. That's it. Canada, it's 2.5%. In Europe, it's negative. And you know, the last inflation print was 9.1. The core was 5.9. Here's a small, you know, this is an econometric study which has worked over time. It's something called the Taylor rule, which in kind of, if you simplify it, what it says is that the overnight Fed funds rate should be about the inflation rate you want, plus the difference between the inflation rate you have, plus 1.5 times the difference between the inflation rate you have versus that which you want. If we only consider core inflation right now, that numeric is 2% plus 1.5 times 6 minus 2 or 4. So that would say the current Fed funds rate today should be 2 plus 1.5 times 4 is 6, or around 8%. In general, we are underestimating. I think in the market in trying to bottom here is underestimating the pain that we could be absorbing on a go-forward basis. And one area which seems a little like today, and it's a little, you know, and it's a little frightening to compare. But you know, if you go back to 2000, the market went down about 30%, in, you know, a little faster time frame, a month, and that's when they were rates were rising during that period. It kind of compares to the 30% decline in the NASDAQ over the first 6 months of the year, while the Fed's been raising rates over the last 3 months of that period. The market back in 2000 then had a reflex rally up 15%. That was a happy event. But then it fell a further 60 over the subsequent 12 months. And it might be interesting to compare the situation now versus then, aside from maybe at least the first part of that metric kind of matched. One difference is, you know, commodities back then were not very volatile. They're really volatile now. That can't be a good situation now versus then. Second is housing was fairly stable back then. Many folks think housing, you know, has peaked for a while as rates have risen and affordability has gone down. The housing part of the equation can't be good now versus then. But there is one positive, is that back then the market was trading at close to 30 times earnings. And that's, you know, right now I think it's fair to say, based on 2022 earnings, you're somewhere in the 18 or so vicinity. So in some ways we're worse off than we were then. And you are, and plus you are going to be fighting the Fed for quite some time. But the one thing on the other side of the ledger, which may be able to ameliorate things some, is valuations are less than they were back in the 2000 timeframe. Having said all that, though, it does feel like to me, at least I'd like to urge investors to show some caution. It sure feels like when you're fighting as many interest rate rises as we are going to be feeling, it does not feel like you want to be heroic in this market. And I would think the odds of a lower trend are higher than an upper trend from here.
So one of the most common arguments we hear is the Fed can't raise rates materially because they just can't afford the debt. They were too much of the government's revenue is just going to go towards servicing interest.
But I think that's one of the big, people think that's a very real chance. If they do that and the Fed decides to, for lack of a better term, chicken out, that just means inflation keeps roaring. I mean, what we have seen both in the past and now is when inflation is roaring, the markets have a hard time doing well. And so I understand the basis that if the Fed finally stops, it'll pave the way for maybe better equity valuations. But the Fed stopping will make the inflation fighting job incomplete, and markets generally perform poorly during times of roaring inflation. So
if we look at the data, it looks like inflation's actually coming down now. If you look at it on more of a month over month basis, and that's, I assume part of the problem here is that the Fed or the financial media or most analysts, it's just like we're all in this group thinking habit of using a year over year number, right? So we're all comparing it to, where oil and gas were a year ago. They've gone up substantially, and oil and gas really started to rip there October, November, December. Do you think that we still have a shot of inflation being, transitory? Obviously it didn't happen as quickly as the Fed would have liked. But we got the Kathy Woods out there that are saying that it will ultimately be transitory. You think that in the end we could see some deflation start to kick in, or do you think inflation's here to stay?
I think inflation, certainly core inflation is going to be here for a while. I mean, one thing that to me that was kind of troubling in the last inflation print is that the cost of shelter, which is about 25% of the overall CPI calculation, was only up 5.6%. I think to me, it seems like as you start factoring in housing prices, rent prices still rising, that giant part of core is going to rise almost unabated for a while. I mean, I just don't. I mean, here's the basic thing. I just don't think trying to fight inflation that we're seeing with 2% interest rates is enough. I mean, there has to be a lot more medicine dispensed to quell the problem than has already been administered, and the market is hoping that's going to be cut down pretty dramatically. I think that's an extremely positive scenario hope, and not the most likely path.
You think that we could look at Tiff Macklem and the Bank of Canada as a bit of a leading indicator here? I assume that Tiff's talking with the Fed, and Tiff's language has really been, we're going to be aggressive here. We're going to be very hawkish. Use terms like we're going to front load. And 100 basis points. I don't think anybody had that on their Bank of Canada or Fed bingo card going into the year. And suddenly here we are with a 100 basis point rate increase. Do you think that we could see a scenario where the overnight rate actually ends up north of 4%?
Oh, I think it's very likely. I mean, keep in mind, let's say the Fed only does 75 this time. That brings you to 2.5. I mean, based on kind of the comments I gave you first, the rate has to be much higher than it is right now to quell current inflation. And if if we tip down from 5.9 and a core to 5.5 or 5.4 and a core, it's still way too high. And from, the Fed's a political body. One of the great complaints against President Biden is that inflation's roaring too hard. I think he has to be leaning on the Fed to do what he can, to do what they can over the next few months to lower inflation, to give him a better chance in the midterms. I mean, I just don't see this idea of a Fed being stopping near term, pausing near term, given all the problems that you're facing right now. But the biggest thing I'd say is given this situation that's happening in the markets, I don't think we are priced for a substantial sequence of pretty high Fed action for a while. I think the market is looking at this with very rose-colored glasses.
What do you think the chances are that we see high interest rates coupled with quantitative easing?
Oh my God! Well, I mean, if we start quantitative easing, things really, the economy really went south. And I mean, if we see quantitative easing, for sure there's high rates, because that means we have given up on fighting inflation. I mean, this is a terrible quandary that the Fed and other central bankers are in. One thing I just mentioned off the side too is, keep in mind, Europe hasn't raised rates once yet. There's still negative overnight rates in Europe. I mean, this is a global economy. None of this is helpful in terms of trying to bring the course of inflation down in the Western world. I mean, we are, I understand we put all this stimulus out there to save the economies from COVID. I understand that. But I think there's more of a price to pay for what we did, and the market hasn't fully encapsulated that yet.
Okay, so let's change gears here. One of the areas that you really cover quite extensively over at the Dive is electric vehicles. Lots of different areas we can go here, but I'm going to give you one of my general theories or theses that I've generally been wrong to date on, which is I assumed that at some point we would see the original automakers get more traction in the market as they started to release their new vehicles. Hasn't really happened that way, but it does look like, Tesla's starting to show some sort of cracks in their strength as the global leader. We recently saw that they lost the top spot to BYD. What's your take right now on the electric vehicle market? Where are we in the life cycle? And do you think that Tesla is going to remain number one over the next 5 years?
I think there's going to be growth, but and I also think Tesla has such a commanding lead. They have a chance to be the number one vehicle for quite some time. The problem I have is the market has been so ebullient on the startup EV guys, and probably the two most famous are Lucid and Rivian. And Lucid's one of the most popular stocks in the overall market. But when you dive into it a little more deeply, Lucid has an enterprise value somewhere in the neighborhood of $29 billion. They are gonna produce between 12 and 14,000 cars this year, which means they're going to generate about $1.3 billion in revenue. They trade in the low 20s enterprise value to revenue. I mean, it's astonishing. I mean, last quarter, their cash burn was a mere $680 million. And this, at some point, they'll produce enough cars to turn profitable, but the market is conferring far too much of a valuation on them at this point in their life, in their life cycle. And I would, if I could say overall in the EV sector, the people understand that there's substantial growth of this industry, but the valuations, even after a lot of these names have gone down 60% or more, they're still not consistent with the cash flows these companies are, in most cases, the negative cash flows these companies are spinning off.
Does that not make for a sexy pairs trade where you take, you long one of the traditional OEMs and short one of, the Lucids or Rivians, or do it on a basket basis?
It's entirely possible, but I'll just tell you, based on history, being short a meme stock when that meme trend goes into favor can be an extremely painful situation. I mean, let's see, Lucid right now, about 23% of their float is short. I mean, one reason why that's so high is the Saudi government owns about 60% of Lucid, so that's not considered in the float. And so you have, but once the meme stock craze comes, and it seems to happen about every 6 weeks or so, those couple days when meme stocks soar can be extremely painful days when you are shorting overvalued names. I guess my guidance on Lucid and to a lesser degree on Rivian is that I'd advise your viewers to really stay away as opposed to a pairs trade, because the pain during those few days that inevitably happen can be extraordinary. So I'm just kind of urging kind of more of a stay away than a short position.
What's your thought on Coinbase and Robinhood here? You think that at some point you maybe look at a Robinhood and you go back to that sort of network effects argument where we say, okay, they got tremendous users on a platform. Maybe they're not generating a ton of cash flow, but we've seen the stock get beat up quite a bit. Does it get interesting at some point, a name like Robinhood?
I mean, it has to. I mean, of all these specs, that's the one that's kind of interesting. Simple numbers, that enterprise value is about $7 billion. $6 billion of that's cash. Of course, there's a but. In the last 9 months, they generated a negative operating cash of about $300 million. When you add this quarter, it's going to be much worse. So it's a giant cash burn company. Second is that they employed, and this is how they made their money when they were popular, is they employ this thing called payment for order flow, which essentially means you're selling customer orders to other entities and receiving a fee for doing that. The SEC is adamantly against that right now. So it's very possible that one of the main sources of your revenue, 2/3 of your revenue, might be compromised by SEC action. But having said that, here is still a company which has $6 billion of cash, is valued at $7 billion right now. Stranger things have happened than people taking a flyer on a company with that much cash. Robinhood, I certainly wouldn't be short. It might be a speculative long for people with strong stomachs. Coinbase, I would say the opposite. Coinbase is right now it's about an $11.5 billion enterprise value company where cash flow is horrendous. I mean, I don't think I've ever seen a change this volatile where they produce operating cash flow. I think it was of like almost $3 billion in the fourth quarter of last year. It went to minus $800 million in the first quarter of this year. I'm not sure I've ever seen as large a change for any company. It's going to get worse. I mean, right now they have about $6 billion of cash. I think going back to the markets is entirely possible. But the single most troubling thing is the way Coinbase works is they more or less charge a 1% fee on all digital currency transactions. Binance is coming into the market on a Robinhood-esque commission-free trading model. Why in the world would I stay with Coinbase when I could trade for free with somebody else? It just feels like both fundamentals and a cash flow problem are still confronting Coinbase, and I understand that this was 370 or so last fall, and it's down into the 50s. To me, it feels like there's still downside here. Whereas, in my opinion, for Robinhood, it's not a wonderful story either. But your downside is much more contained in Robinhood than in Coinbase.
Do you think Voyager should be a bigger story for people who are, on these crypto exchanges? I mean, we've got this platform that was apparently making loans to hedge funds that were investing in insolvent crypto companies, and then ultimately that took the company under. How do I know that if I'm doing a wire to send a bunch of money to Coinbase or Robinhood, or one of the many crypto exchanges that the platform's not going to go insolvent and take my funds and use them to pay off their debtors?
The answer is I think you're pointing out one of the great risks. There's no way as an outsider you could really know those details. And as you might remember, that issue came up in the aftermath of Coinbase's first quarter earnings, where in the event they become insolvent and you have an account at Coinbase, that money isn't insured. I mean, you then become an unsecured creditor of Coinbase, and you're fighting for your money in the bankruptcy courts. I mean, but the simple answer to your question is there is not, as an outsider investor thinking of making such an investment, there's no way you have enough detail to know that problem is not one that you're facing.
Okay, so Jim, gotta ask you, you're on here. You've had a bunch of success over the last couple of years with some of your stock picks. What names do you like right now? Are you long anything?
There's two names I'd like. I mean, I don't want to be Debbie Downer this whole conversation. There's two names which, and one speculative, one kind of a yield play that I think makes sense. The first is a company called Lithium Americas, LAC. Enterprise value is about $2.5 billion US. The biggest positive there is they are probably 8 months away from starting production at a lithium facility in Argentina. Enormous. They own 49%. A Chinese company called Ganfeng Lithium owns 51%. That by itself it introduces the chance that Ganfeng, a giant company, could decide to take it, possibly in time take out.
They've been known to do that.
Take them out. But this is the key number here is, based on lithium prices that are about 1/5 of what they are now, 1/5, 20% what they are now. This plant in Argentina was thought to be producing about $300 million of EBITDA. Multiply that by 4 or 5, then multiply that times 49%. That's a big number. I mean, it is possible this company, once production starts, could be showing EBITDA of $700 million. And they also own a plant in Nevada in the U.S., which may start construction at some point, maybe late in 2022. That would be kind of an addition. But what I'm really trying to say is, it is possible this company could start entering service in 8 or so months and generate $700 million of EBITDA for a company worth $2.5 billion right now, with a well-heeled majority owner of this plant. I mean, it sure does feel like this is a reasonable speculative play. I think it's down around 30% in the last 6 or so weeks. The market has thrown out all risk. This is one that folks might consider doing some research on. I think that's a real speculative play. Two last things is, lithium prices have exploded and those prices have not come down. And second is, there's been a lot of asset sales across the world of lithium assets recently, just this year. The prices have been enormous. So at least the participants in the lithium business are not the people who are buying this. The EV battery makers are not doubting the importance of lithium and the value of it. The people who are doubting an outfit like Lithium Americas are stock investors. I would say the direct participants in the industry probably have a better insight into the true value. So I would label that as a real reasonable spec. The second one is called Kinetic. That trades in the U.S. KNTK. It's a midstream company which operates in the Delaware Basin, which means New Mexico and Texas. The key to this is they own giant shares in natural gas pipelines, one of which just held an open season to expand the pipeline. The open season was extremely well received. Pipeline's going to be expanded. You'll probably enter service. The new capacity probably enters service the fall of 2023. When the company reports earnings, I think they are very likely to start moving guidance up. These are all positive fundamentals, but here's maybe the most important thing. Company pays, this is a 35 and change dollar. The price is 35.85, I think, pays a $3 dividend. It's a safe dividend supported by tremendous free cash, an 8.65% yield. The comps trade in the 5s and the 6s. I think there's a real chance as folks appreciate the additional earnings power from the pipeline expansion, that this required yield will be skinnied down from 8.65. And actually, I think there's a very good chance of the dividend increase on top of the $3 next year. I think so. I think risk reward. This stock has come down from about 40 over the last handful of weeks as oil has come down. Shouldn't have really traded with oil. I think that along with Lithium Americas are two pretty good long specs in here.
Okay, Jim, last question I got to ask you, and I've been meaning to ask you this for probably a year now. Whose signatures are on those footballs behind you?
The biggest thing is there's actually a bunch of Michael Jordan stuff here, but I'm a pretty big both football. There's some Bo Jackson and Tom Brady in here too. So this is much better company than I am. But there's some of these things are pretty. The signatures are pretty important guys.
So you can't tell us what any of the footballs are behind you?
Oh yeah, let's see. What did we say? I see there's a Lawrence Taylor, and then there's up there we have Gronkowski, Bo Jackson. There's a Will Chamberlain ball, and you might see towards the top there's a glove signed by Muhammad Ali. So wow. It's a pretty eclectic collection.
Oh, look at you, Jim. Thanks so much for hopping on here and doing this. It's a pleasure speaking with you, and I'm grateful I get to work with you regularly over at the Deep Dive.
Well, listen, it's been a pleasure. I'm really thank you very much for having me, and I hope you provide a little information for your followers.
Awesome. Thanks so much, Jim.
All right. Thank you very much.
All right, everybody. Thanks so much for watching. And if you could do me a big favor, hit the like button, subscribe, and ring that notification bell. Or even better yet, let us know what you think in the comments section. All right. Thank you, everybody.